welcome to our webinar today on pros and cons of capital raising models for investors. And we have a guest today speaking on this topic. It's going to be Randy Smith. In just a moment, we'll bring Randy on to talk to you about different capital raising structures and how they work, basically how they work for the investor and what you should know. You'll also have the opportunity to ask Randy questions. So just keep that in mind as he goes through his presentation. We'll take questions throughout. There is a question box in your navigation. Please type any questions you might have in there. We also are happy to share the slides with you. If you would like the slides, please just make sure to take my contact information or Randy's, and please feel free to reach out to us. We'll happily email you the slides. My name is Larissa Greene. I'm with Advanta IRA. And I've been with Advanta IRA since 2011. I'm going to tell you a little bit about the company in just a second. But basically, my role is I do a lot of education for Advanta, and I also do business development. So if you're close to one of our local offices, I may have met you out and about representing the company at different educational events. And then I also do webinars. So I just did a webinar not too long ago on 401ks and how they work for small business owners. But if you ever see a webinar in our list or on our calendar that you can't attend, please feel free to email us and we'll make sure to get you the recording. This webinar will also be recorded, and if you would like the recording afterwards to share or review, it will be sent to you by email in just a day or two, usually. Advanta IRA does not provide any investment, tax, or legal advice. Please keep that in mind. All information and materials are for educational purposes only. So although we'll be talking about investment structures today and different structures for a self-directed retirement account, please be sure to consult with your attorney, accountant, and any financial advisor before making any investments. Advanta IRA is a self-directed IRA administrator, and what that means very simply is that we hold investments that are not market-based. So any private investment can be held by Advanta IRA as long as it's within the rules for a self-directed retirement account. Today, we're really not going to be talking about the rules, but we do have webinars where we talk very specifically about investments allowed within an IRA and some investments not allowed, as well as people that you can't transact with. If you're interested in hearing about any of that, please feel free to email me, and I'm happy to send you a recording from our library. Advanta IRA has been in business for over 20 years at this point, but we've always been the same people doing the same thing. So we've always been a self-directed IRA administrator, holding accounts for our clients, keeping in mind that we provide a service. So we don't actually sell anything at all. We hold the account, you find the investment, and we help you get it done in the name of the retirement account so that your retirement account can retain its tax-deferred or tax-free status. And we have 2 offices, but we can help anyone anywhere with a US-based retirement account. So we're located in the Largo or Tampa Bay area of Florida and also Atlanta, Georgia. But we have clients that are nationwide and even worldwide. So again, just a US-based retirement account is all that it takes, and you can self-direct that into the private investments that you see fit. We have a little over $2 billion in assets under management. And I'm not really sure how many clients that makes up at this point. I think it's a little over 12,000 accounts. And all of our account holders receive an account manager dedicated to their account and helping them make investments, make annual contributions, and answer any questions that our clients have. So if you're not an Advanta IRA client, please feel free to reach out to us and find out more about how we can help you ultimately take control of your retirement account and make investments. So what is a self-directed retirement account? A lot of times people will tell us, I have a self-directed IRA with my brokerage account. I make the investments that I want to make through them. But keep in mind that they still have a list of investments that they're selling you, and that those are market-based investments. And so a truly self-directed retirement account is a little bit different, where we don't sell anything at all. We just allow you the opportunity to find those investments that you feel comfortable making and see fit for your retirement account, and also to truly diversify. So our clients are investing in things like real estate and private notes and mortgages, private placements like we'll talk about today, and things like precious metals. When we talk about precious metals, we're not talking about investing into a fund, but rather holding physical gold and silver bars, coins in your account through your retirement account. We also see people trade foreign currency and do futures trading, and really the list goes on and on. And so if you'd like to learn more about that, like I said, we have webinars where we talk about all the different types of asset classes we have seen here at Advanta, and I'm happy to send that information to you. Most people haven't heard about a self-directed retirement account, just very honestly because most brokerage firms and, retirement account firms don't hold private investments. They've made it a business decision to hold market-based assets. They're not really sure how to do record keeping for real estate in an IRA or a private mortgage, or maybe even a combination of those two. So an IRA account that holds real estate and has a mortgage on that real estate, they're just not willing to handle that or handle the record keeping for it. And so that's really where we come in and fill the gap in the industry for that service. And actually, less than 4% of all retirement accounts are self-directed or hold private investments. I always like to include this slide because for some reason, people are always under the impression that it has to be a Roth IRA if you're going to self-direct it and purchase real estate or invest in syndications and things like that. And the truth is, if it ends in IRA, it can be self-directed. So you have up here, of course, traditional and Roth IRAs. Those are the most common retirement accounts that we see, but it could also be an employer-based IRA like a simple or SEP IRA. And then, of course, solo 401ks, former employer plans. And the reason there's emphasis on former is because if you're still currently employed, you have a W-2 job, it's less likely that you can move money from it, but not always entirely impossible. So you always want to check with the plan administrator. And then we can also help you with health savings accounts and education savings accounts. Just simply because the rules for self-directing those accounts are the same, we'd be happy to help you open those accounts and make your annual contributions and invest through those accounts as well. We're going to talk about real estate syndications today with Randy. So I wanted to just include up here different types of real estate investments that we see on a regular basis at Advanta. Of course, purchasing real estate directly through the retirement account, owning, for example, 123 Main Street as an asset in the account. We see joint ventures and syndications, of course, real estate options. We also see people invest in tax liens and deeds. And so if you're familiar with the concept of purchasing a tax lien, that can be done through an IRA account. And we do have, sort of what I would consider tax lien and deed season at Advanta, where depending on the state and county you're investing in, there tends to be a time that they're doing those auctions and you can bid on tax liens. And so that's usually where we'll hear investors reach out to us and say, okay, I want to make a deposit with the county so that I can bid on tax liens and things of that nature. We also do see people do private lending through their retirement account, and really the list just goes on and on. And we do have webinars based on real estate investments and private lending, basically being the bank with your IRA. I didn't see any questions pop up, so I'm going to turn it over to Randy at this point. If anybody has any questions as Randy goes through, please feel free to type any questions into the chat box and we'll get them answered. How are you doing today, Randy?
I am doing really well, Larissa. Thanks so much for having me on the webinar.
Absolutely. Thank you for joining us.
All right. Well, we'll go ahead and jump right in. I have about 30 minutes worth of content, so I'm going to try to move as quickly as possible through this, but certainly jump in and ask questions, as Larissa mentioned. And I do have to give like a shameless plug for Larissa and the team at Advanta. I've been an Advanta customer now for, I believe, 3 or 4 years. I hold 5 or 6 different personal investments with them in an Advanta self-directed account. And I've referred, I think, 20 to 30 people over to them as well that have all had just amazing, amazing experience. So if you're not a client of Advanta yet, I would encourage you to get on the phone with Larissa and find out what kind of options could fit for you. So
Thank you so much, Randy. I appreciate that.
Yeah, of course. So now that the shameless plug is over, let's kind of jump into it. So we're going to talk today about capital raising models, and this is something that I wanted to share with the audience because I think it's important as a passive investor to understand the different models that are out there, because there are certain pros and cons to all of the different ones that are out there, and they have different impacts on your returns and your ability to get access to deals. So we're going to jump into those things and the things that passive investors need to know before making that first investment. Right, and I was told we were going to have fun with progressing slides, so bear with me here. Very good. All right, now I know you already saw a disclosure from from Larissa with Advanta, but I have my own as well. I am actually the CEO and founder of Impact Equity. I am not a tax or financial CPA advisor. I'm certainly not an attorney. So everything I share with you today is just simply for education purposes. I always encourage folks to have a great tax and legal team and accounting team that they're working with before they get into any type of passive investments. Okay, so here's what we're going to cover today. I'm going to spend a little bit of time talking about who I am and my investment background and what I'm doing today. And then really the core of the material today, we're going to jump into 4 main common models that you will likely see in this space if you're a passive investor or plan on being a passive investor in the future. And then lastly, I'm going to walk through just kind of a high-level overview of fund structure fees, just so you're aware of what those can look like and how they impact you. So let's go ahead and jump into the bio. All right, so here's me. I spent 25 years in corporate America in various sales and sales leadership roles. The majority of the time that I spent in corporate America was with 2 large organizations. One was with American Express, and I was in a business-to-business sales role where I met with entrepreneurs and C-level executives and helped them implement American Express business tools into their business. Prior to that, I spent 10 plus years with a company called Waste Management, and I led sales teams selling their services to businesses as well. So I've been in and around small business and medium-sized business for a lot of years and actually grew up in small business as well. So what happened with my background is basically halfway through my last 10 years that I spent in corporate America, I got to a point where I started to accumulate some nice dollars in addition to the 401k that I was saving with my employer. And I made the decision to start investing in real estate. So I started, like so many do, buying single family homes because they were easily to understand, they seemed accessible, and it seemed like something that I could do part-time or on the side while I was working my sales role. So I had varying levels of success in that, and I bought a couple of turnkey rentals in Kansas City, and then found out very quickly that I wanted to be more in control of that process because I had a pretty negative experience with that turnkey operator, and decided to do the BRRRR strategy. And for those of you that don't know what that is, it is buying single family homes and then you renovate them and you rent them out to a renter, then you refinance them to pull all of your money out, and then you repeat or you go on to the next one. So I did that a handful of times, and as I mentioned, I had varying success, had a lot of obstacles and challenges that came up, but ultimately we did create quite a bit of equity in doing so, but it wasn't something that I thought that I could scale the way that I wanted to scale it, certainly with the amount of time that I had to do so. So I ended up shifting over to the passive investing space, more so on the front end, to try to get an understanding of how this whole syndication model worked, to see if it could be something that I could get into in the future as a full-time role. What I found out very, very quickly was that syndicators are working many, many more hours than I wanted to work, and quite often they had a lot of the same challenges that I did in the active investing, but at a much, much larger scale. So I decided to just simply be a full-time passive investor and started investing very, very heavily into the syndication model through various different operators, various different asset classes, and I really fell in love with the space. It was amazing to be able to invest my dollars with an operator that was, spending, 50, 60 hours a week with teams that were experts. And it was just a better place for my capital than risking it to me out there trying to be a weekend warrior on it. So I jumped all in, I sold all the single families, and then invested very, very heavily in the space. So fast forward a couple of years, and I found myself getting laid off from that corporate America job one more time. I had been laid off from the previous employer, and it happened again. But fortunately, this time, my passive income was large enough that it actually offset the majority of my household expenses. So I didn't have to go out and get another W-2 job or work for corporate America. And I made the decision at that point that I was going to start teaching people how to do exactly what I had done. So I launched Impact Equity, which is a real estate investment firm that helps the new or newer passive investor invest in their first, second, or third passive investment in various multifamily or other related asset classes. So since launching about 18 months ago, we've done 12 deals, and I've used all of these models that I'm going to talk to you about today. So that's a quick overview of who I am and who Impact Equity is. And let's jump into the first model, which is the syndication model. Okay, so most of you probably already know what the syndication model is, but essentially at a very high level, syndications allow an operator to go out and buy much larger assets than what they might be able to buy on their own, because they partner with investors like you and I to bring additional capital into those investments. And this is the traditional model that you see quite often. There are a lot of really, really great operators out there. There are some operators that are not so great out there. But you have a general group of folks. It's usually could be as little as 1 or 2, or it could be as many as 8 to 10 I've seen on some of these, or even more. So there's a lot of benefits to these because they're very straightforward, transparent fee structure, less involved individuals in the management of those assets. And there is less risk in these models because there's less people involved and there's less layers. Some of the cons with these is that as an investor, if you're dealing in the 506B world, which if people don't know what that is, certainly ask the question. But if you're dealing in 506B world and you don't know the operator directly, you will never see these deals. So one of the biggest cons of these is that these models are only available to those people that know the syndicators directly and have a direct relationship with them. So that gives the investor limited diversification because their odds are not even seeing these deals. And if they are, they're seeing very few of them. And if they are seeing them, they're usually with a small group of operators that have one business model, that focus on one geography and focus on one business plan. And another con to this is that quite often syndications have minimum investments that are out of reach for the newer or traditional passive investor. So this is the basic syndication model, and we'll jump in now to the next level and discuss the next model. Okay, so this is kind of a blend of all of these different funds, and I call this a co-GP situation. When you look at the structure of this, it looks very, very similar to the traditional syndication model, and this is ultimately exactly the same thing, but the syndication group or the lead GP is buying this asset while taking investor capital from their own investors, but they end up partnering with other individuals like myself and Impact Equity to be a co-GP or co-general partner in the operating entity. Now, the benefit to the lead GP or the general partnership is that by partnering with co-GPs, they get access to all of the co-GPs network and investors as well. And the co-GP actually becomes a member of the managing entity and has ownership in that fund. So you'll have a handful of lead general partners, and then you'll also have co-general partners that are involved in the day-to-day operations of the business, and that brings additional investors to those opportunities. So there are some pros to this and there's some cons to this as well. So from the general partnership standpoint and from the investor standpoint, the main benefit is that this gives the operator the ability to share these opportunities with a broader network, and they get access to those additional investors. It's a fairly easy business structure for investors to understand because there's not any additional legal structures. It's really as simple as people like myself, Impact Equity, are just an actual member of the general partnership. And in these models, there are generally no additional fees as well. So investors investing into these opportunities get the exact same terms that the investors get that invest directly with the general partner. Now, so if all of these pros were the case, people would ask, why don't we see more of these? And the challenge is that the SEC is starting to frown on this model more and more. And the reason for that is that as you get more and more people involved in the capital raising and the management of this asset, there are requirements by the SEC that say everybody that's involved in the general partnership has to have material involvement in the management of those investments. And individuals cannot be paid just for simply bringing investment dollars to an opportunity. So those challenges make it very, very difficult if you have multiple co-GPs that are involved in a deal, because they actually have to have material involvement in the management of that asset. So in the few that I am actually involved, yes, I'm bringing investors to the opportunities, but I'm also required to have asset management duties and get due diligence duties, and I'm required to shop the competition and any number of other activities. But you can see that that could be challenging if you had 8 or 10 or goodness, 10 or 12 or 15 different co-GP partners. That starts to get very, very messy, and it's hard to be able to show that those individual co-GPs have material involvement, okay? And at the end of the day, co-GPs are generally only getting a very small portion of the ownership of that asset, sometimes as little as 2%. So while they do have, I would say, influence on those deals, they're not really decision makers, and they are not involved in the day-to-day activities. So you can see why the SEC frowns on this, because at the end of the day, these are investments that we're selling and we're providing to our investors. So we need to make sure that we're in compliance with the SEC. Again, this has the same minimum investment requirements because it's the exact same deal that you're investing in. So at times those investment limits can be out of reach for the traditional investor, okay? All right, so let's move on to the next one. And this is the one that I focus on the most, which is called the fund-to-fund model. Bear with me here. All right. And I have this labeled as single asset fund to fund, but it isn't necessarily single asset. You can have more than one asset involved in these fund models. But the important differentiator from what we will discuss on the next slide is that these assets are identified on the front end before they are presented to the investors. So we'll get into the differences there more on the next slide, but these are single or multi-asset fund-to-fund model, where you have a fund which is managed by a company like Impact Equity. They partner with an operator or a lead GP to bring additional capital to those deals, but instead of the investor directly investing with the lead GP, they're actually investing in the fund manager's fund. So investors, if they're investing directly with the lead GP, they invest directly with them through their portal and get the exact terms that are offered by them. The fund investors are actually investing in the fund or fund-to-fund model by a company like Impact Equity, and the fund is pulling those dollars, and essentially that fund will write a bigger check to the lead GP or the general partner for the investment. And because they're bringing a bigger check, the fund manager will quite often get better terms than the traditional investor would get if they went directly to the lead GP. So what are the pros and cons of this one? And this is a model that's being used more and more because it is compliant with SEC regulations. fund managers are not getting directly paid for their capital raising, but the fund is earning returns and the fund managers earn their income through the fund, not directly through the lead operator. Okay, so what are the benefits here? And why is everybody moving towards this model? Well, ultimately, from an investor standpoint, it's really the best of both worlds. You get access to diversification across many, many different asset classes and geographies and business models and operators, because the fund managers generally are working with multiple operators and they've done the due diligence, they've vetted those operators, and they have their own buy box or vetting criteria or process that they follow. There is an additional LLC, which is the fund, so you have an added layer of protection between you and the asset. So the asset is owned in an LLC, and then the fund is actually owned in an LLC as well. And some investors actually choose to invest through their own LLCs. So there's a number of different protections that come through those and added layers, essentially. Now, some of the other benefits that you might often get is that as an investor, you could have a relationship with just a couple of fund managers and then get access to a bunch of different deals. You're going to be able to use or leverage the expertise of the fund manager and their vetting and due diligence process. If you are a income or a W-2 employee and you spend a couple hours a week on this stuff, you can rely on these fund managers that this is their full-time job and this is what they're doing, is finding great opportunities to serve their investors. Ultimately, you can get access to deals that you wouldn't have access to if you didn't have a relationship with that fund manager. And quite often, you'll find that minimum investment size are significantly smaller with fund managers because they get to choose what those investment levels are. And from the general partnership standpoint, they enjoy working with fund managers primarily because they get larger checks and they don't have to manage the relationships or the investor relations for the 20 to 30 to 50 investors that the fund managers are bringing into those deals. So if it was all pros and no cons, everybody would be doing this and there would be no other options that are out there. So clearly there are some cons. Probably the biggest one is anytime you add an additional layer or an additional entity structure within an investment, there are additional risks that come up. You have additional individuals you need to vet, you need to feel comfortable with, and ultimately there's just more folks that could potentially drop the ball. There are funds that or fees that are being earned at the fund level. So depending on the structure of that fund and the analytic that they use, it is possible that you could get better returns going directly to the lead GP. But if the fund managers are managing their structures as I do, or as many do that I know, quite often the returns are going to be even better. One other con that comes up quite often is this stress around the timing of K1s and reporting and communication and updates. Ultimately, what happens is the fund is investing as an LP into these investment opportunities. So the fund has to wait to get the reporting, the distributions, the updates, the K1s before they can then turn around and share it with their investors. So, even in the best case scenario, the general partner is sharing all this information and then the fund manager turns around and shares it the same day. But in all likelihood, there is days or even potentially weeks that can pass before the information that was shared with the lead GP gets all the way to its end investors. And then one that's actually not shown on the screen here, it looks like it's cut off a little bit, but there is an option where if you're making investments in multiple operators and multiple fund managers, quite often, even if you're only investing with one fund manager, that fund manager might have to leverage multiple portals, which can get to be a little confusing because if you invest with, impact equity, I can share with you today, my investors have 3 different portals that they have to go to. And that will only get more and more complicated as we continue to grow. So the larger fund managers, and our plan for impact equity is to move everybody into one portal, but that can be challenging and confusing for the investors in this one. Okay.
And Randy, we did have a question pop up before you go on, and I know you touched on this on one of the first structures that you talked about, but we had somebody ask about having to be at least a sophisticated investor or, of course, accredited for these structures. So the last few that you covered, are those all going to be associated with accredited investors, sophisticated, or is it friends and family sometimes? How does that work?
So that is a very, very good question. And I will say, if you line up 10 different SEC attorneys, you are probably going to get 10 different answers to this. So the information that I use and the process that Impact Equity uses, and of course, I'm not an attorney, so check with your attorney, but I choose to only bring accredited investors into my funds, because the advice that I've been giving, or the counsel I've been given from my legal counsel, is that we are selling a security by selling a fund versus a direct investment in real estate. So some fund managers will take sophisticated or non-accredited investors. I, at this point, choose not to, but I would check with your attorney to find out their guidance on that. Okay?
Great. Thank you, Randy.
Perfect. All right, so let's go on to the last one, and I'm not going to spend a lot of time with this because this is more, it's very similar to the fund to fund. Oops, sorry, let me go back here one page. All right, I put this on there again more for just high-level educational overview, but you hear a lot of people talk about blind funds, and there's various names for these, but the fund that I like to use is blind because the fund manager will have a buy box or investment criteria that they follow, but they have not identified assets, or they have not identified all of the assets that they're going to be raising for. And I have chosen to stay away from this type of offering simply because, yes, I have experience with investing passively and actively, but I only have 18 months of track record with investing in the space as a fund manager or co-GP. So I didn't feel as though I have the credibility or the track record to do a blind fund for my investors. Now, I think as I have more and more years experience, it might become an option for us, but ultimately what's happening in these situations is you have a fund manager that says, here's our buy box, and we're going to raise capital on the front end because it's very advantageous for them to have access to this capital before they go into the capital raise. And once they raise the capital, then they start to just go out and purchase assets. There are plenty of pros and cons with this one as well. It's similar to the fund-to-fund structure because they're ultimately raising capital and then buying bigger assets. And you will get diversification across multiple assets because that generally is the goal. But most times in this space, you will see that it's usually one asset class, it's usually one geography or a limited number of geographies, and more often than not, it is one business plan or structure that they are using to buy these assets. So diversification is good in that you're getting diversification across assets, but generally not across the other metrics that I like to have diversification on. I have on here that this one is generally 506C. I've not seen blind funds that are not 506C, so those are only available to accredited investors, and I feel very confident in that one. And then probably the biggest benefit to the operators is that they have more flexibility and they have more buying power because, and they actually have a better story to share when they're buying assets because they have the capital and they don't have to go to raise it. Some of the risk that occurs, or one of the largest pieces of the risk, especially in the last 18 months or so, is operators will go under contract on a new investment, and then for one reason or another, they're not able to raise the capital and they have to back out. So investor capital ends up sitting stagnant on the sidelines for months and months without those dollars going to work. So the fund manager loves, or I'm sorry, the blind fund manager loves this because they have more power in the negotiation and purchasing process. But I think this hurts the passive investor because dollars aren't going to work right away. Some of the cons on here, in my experience, is that funds with multiple assets will usually have longer hold periods because they need to execute the business plan on all of the assets and then either sell or refinance on the back end. So generally, you're going to see longer hold periods. There's this uncertainty of capital allocation. And then again, as we mentioned, the difficulty with diversification. So that's a very high level on blind fund and some of the reasons why I've stayed away from these and why I personally don't invest in them. It's not to say that it's not a good option for folks, but it's not something that I've chosen to do up to this point. So let's go on to kind of the meat and potatoes about how this actually affects the investor directly when it comes to returns. So I mentioned one of the drawbacks of the fund to fund model, whether it's single asset or multi-asset, is that the fund manager will quite often have their own fees that they're charging, but when that's offset with better economics that they're receiving because they're bringing a bigger check, quite often that is going to equate to better returns for the end investor. So I wanted to share this example, and this is an example right out of Impact Equity Playbook where I partner with a group, and this is very similar to what you see with a lot of folks that are working in the fund-to-fund management space, is retail investors will get one type of return metric, and then the fund managers will get preferential returns or economics because they're bringing bigger checks. So in this specific example, the operator that I work with does a 7% preferred return, and then above the preferred return, they offer a 70-30 split. And if they hit a 2x equity multiple, then the waterfall or the split drops down to 50-50. So if the fund manager then is bringing a bigger check, they will actually earn an 8% preferred return, and the waterfall or the split is actually 80-20. Now, that doesn't mean that the end investors get those returns, but the fund itself is earning those returns because the fund is an LP in the investment offering, okay? The fund manager then chooses what terms they give to their investors. And in my particular situation, I give my investors a 7% preferred return to match what they're getting if they invested directly. And then we give 85% of the fund earnings to the investors, and the fund earns 15%. And we have a $25,000 minimum. So we have a lower minimum. We're giving 85% of the 80% that the fund manager is earning. And the end result is that the fund investors get 69%, and then 31% goes to fees. That 69% is the calculation of 85% of 80%, which is 0.69. Now, that is slightly less than the investor would get if they went directly to the general partner directly. But if and when these investments go over the 2x equity multiple or the IRR threshold, then the upside is significantly higher for fund investors. So that is, I've not figured out a way to put that on paper to show it in a more clearly defined way than that. But that ultimately is the economics behind the benefit, in addition to additional timing and lower investment size and access to these deals. But that's the economics behind the two structures working together there. So this is ultimately the content that I wanted to share with you guys today. And if there are questions, I would love to answer those. And of course, I would love to connect with anybody that's interested in hearing more about impact equity or learning more about these structures, or potentially being on our investor list after we have a conversation to see our 506B offerings. And of course, at impactequity.net, you can see our current 506C offerings, which is a short-term rental through TechVestor. But yeah, I've enjoyed sharing this information with you. I'd love to answer any questions that you have, or feel free to connect or follow me or reach out anytime. I'd love to connect with anybody that's.
Thank you, Randy. And we did have a question pop up asking about fund investment minimum. So what do you typically see as an a minimum investment for syndications?
Yeah, so it's really hard to say. I've seen minimums as low as, well, goodness, I've seen them as low as $10,000, which is very, very rare. And I've seen them as high as $250,000. So the general number that I see is 50,000 from direct investment with syndicators, but it's not uncommon to see. I won't say it's uncommon. Well, it's less common to see 25,000 with fund managers, but impact equity, we choose to do 25 because I think everybody should have at least a portion of their investments in these types of opportunities, and I want to make it available to as many people as possible.
Okay. And how often, I get this question a lot at Advanta IRA, so maybe you can help us understand this. How often do you see funds allow people to partner monies in order to make up that minimum? So if I have an IRA and my husband has an IRA and neither of us have the 50,000 required, for example, could we partner our IRAs together in order to make up that total minimum amount, or is that typically not allowed?
Yeah, so my understanding in this space, Larissa, and I would actually defer to you on this one, but my understanding is that IRAs, I'm not aware of a structure that would allow IRA entities to combine their dollars into one entity. Maybe it is possible, I'm just not aware of it, and I've not ever seen it. From the fund manager or the syndicator standpoint, all that's required from us is that we have a US-based individual with a social security number or an entity that has a tax ID in the United States. So if there's a structure that allows that to occur, we would defer to the experts in those space that create those entities. But my understanding is you cannot combine husband and wife's IRAs into one investment. Now, I will tell you that I've made the exception on my $25,000 minimum to allow a husband to do 15 and a wife to do 10, but it's two separate investments.
Okay, got it. Got it. And so IRAs can partner from the IRS standpoint. The IRAs could partner, but we've had that question a couple of times where will the fund accept that partnership as meeting the minimum, or would it look at that as two separate entities? So the IRA accounts have to remain separate, just to sort of answer your question there. But for example, if IRAs wanted to partner into an LLC, then they could combine funds and make the investment. But I just wondered if maybe you haven't seen syndications accept that as meeting the investment, since it's two separate accounts partnering.
Yeah, it's interesting. So those two entities would form an LLC and then invest under the LLC?
They could potentially, or if the fund manager would allow, they would partner into the investment on, say, one limited partnership agreement, but it would show each IRA bringing funds to the table for that investment, if that makes sense.
Yeah, it does. It's interesting though, because from a tax reporting standpoint, of course, I'm not a CPA or anything like that. It seems from a reporting standpoint that LLC would then get a K1. Well, I guess the individual entities or individual IRA accounts get those as well, technically. But okay, yeah, interesting. Yeah, I'd love to hear others' thoughts on that, or I might check with my attorney as well. But if two individuals came to me and they had an LLC, I don't dig into who owns the LLC and who are the members and the managers. If they're investing under an entity, we don't dig any further than that.
Okay, so you would consider that, meeting the minimum basically because the entity is making the investment.
Absolutely, yeah.
Okay, understood. We had another question pop up about investing basically the investment timeline. If somebody came in after the deadline, so could they make an investment in the middle of the fund? Or maybe a question there that I could add there too is, do you typically see a fund raising capital after they've already closed raising capital? Does that ever happen? And when could you exit the fund? Could you exit in the middle? Leaving, prior to the predicted close of the
Yep.
investment.
Yeah, excellent question. And that is one of the benefits, I think, of working with fund managers is quite often they have a little more flexibility in bringing dollars because we are bringing bigger checks, so we get some preferred treatment there. What I know is a lot of the operators that I work with, they'll launch and literally within days they're filled. But me as a fund manager, I've made a soft commit for a certain dollar amount, and I have additional time to bring those dollars to the general partner because of that relationship. So, as an example today, this is not available to the group here, but I have an opportunity that literally we closed on the asset 3 weeks ago, and yet the operator is still allowing me to bring additional dollars to their deal because they're still raising or still accepting dollars for the construction and the CapEx and reserves. So yes, it is generally working with fund managers, you've got more flexibility and they can take dollars for a longer period of time than working directly with the operator.
And what if somebody makes an investment and decides, let's say it's a 5-year commitment, and if they decide on year 3 that they want to liquidate and, remove themselves from that investment, is that possible?
Yeah, I think that's a very, very good question and something to ask on the front end with the specific operator that you're working with. These are generally illiquid investments, meaning as a passive investor, you don't have controls over when those assets are sold or refinanced, and then your ability to pull your dollars out are generally limited as well. Now, I've heard that there are structures where you can sell your ownership interest to other individuals. I've not ever done that or have had an investor do that. I don't believe it's an option in any of the investments that I've done. But I will say that I've had some investors that have gone through the investment process, they've wired their funds, and then for one reason or another, they've decided that they wanted to get their funds back before we ended up purchasing the asset or those dollars were placed. And we have actually sent those dollars back to them. So if it's available to us, the operators at times can do that at their discretion. But I think once the capital's placed, that gets much more difficult.
Yep, that makes a whole lot of sense. I don't see any other questions here, Randy, so I'm going to thank you so much for joining us today. And as a reminder to everybody on, if you would like a copy of the slides, please reach out to me. I'm happy to share them with you. That reminder will also be in the email that goes out with the recording to this webinar, so you are welcome to reach out to me at that point, and I'm happy to share them. Please make note of Randy's contact information in case you have any questions for him. Thank you so much, Randy.
Yeah, thanks so much for having me. This was a lot of fun, and as you mentioned, I'd love to connect with anybody on the call today or that listens to the recording, even if it's just talking about this stuff. I love talking about this stuff all day long, so reach out anytime.
Great, thanks, Randy. Have a great day.